On today's edition of The Money Show, I am joined by a very special guest. With me in the studio today, I have Miss Monika Halan, who is the author of Let's Talk Money and now also Let's Talk Mutual Funds. This is a book that has just launched last weekend. So Monika, thanks for joining us in the studio today.
Thanks.
And it's a great pleasure to have you among us at our offices today. Great pleasure to have you.
Delighted to be here.
Thank you. So Monika, let's talk mutual funds.
Absolutely, let's do it.
So let me start off by asking you, why mutual funds? So in your book, you've mentioned, on one hand, you've got equities, you've got gold, real estate, but, superseding all of this is one big umbrella of mutual funds.
Correct.
Why should somebody pick mutual funds over all of these other options?
Because mutual funds is not an asset class. Mutual funds is a route to the different asset classes. So I think one of the mistakes that most people make is to think that mutual funds, one, is only equity. Two, it is an asset class by itself. So they will say, I have gold, mutual funds, stocks and bonds or FDs. What the point that they're missing is that mutual fund is a route to buying stocks, to buying bonds, to buying gold, and then combinations of these.
Right.
So, and the reason that I wrote the book is because in the first book, Let's Talk Money, when I was writing the mutual fund chapter, I realized that there was so much to say that it needed a separate book, and I wrote that and then I forgot about it. And then enthusiastic readers have gone on reminding me that you had promised a book on mutual funds. So here it is.
Right. All right. So when we say mutual funds, two words, but very intimidating two words.
Yeah.
For a lot of people who do not have, let's say, a commerce background or a finance background, and when, because of all this advertisement on TV, everybody's, the awareness of mutual funds is increasing, but not a lot of people exactly know what mutual funds are. The biggest misconception going around is mutual funds is only a pool or a basket of equities.
Correct.
So if you could just clear the air around this misconception about mutual funds for the ease of our viewers. So let's say if you were to simply explain the concept of mutual funds to a 10-year-old child, how would you do it?
And I have to tell you that what a 10-year-old will understand will be understood by everyone, because very few people really understand what it does. There are a lot of misconceptions and myths around it. Like I just said, is that an average portfolio needs bits of equity, little bit of debt, you need little bit of debt, gold as well. And if an individual investor starts to buy stocks, tries to find out bonds to buy, gold is a much easier asset class. It's very intimidating, it's very difficult to do that. The example that I have used in the book is of beads.
Beads, absolutely.
Right, which is to say that if there is a whole box of beads and they all look shiny and bright, and you pick 5. Now, out of those 5, one may do very well, one may not, one may turn to dust. How do you know today which of the beads is valuable? You have no way of knowing. Or you'll have to study very hard, get into metal study and evaluating the carat of what you're buying. An easier way would be to hire a person who's an expert who picks these beads. Right? So out of 10,000 beads, you just want at an individual portfolio, you can buy 5, but when lots of investors pool together and this expert is picking these beads, then he's buying, say, 30 to 50 in a single portfolio, for a single portfolio. So you get diversification automatically. Okay. So the expert is better able to judge the value of the bead that he's picking. Now replace the word bead with stocks and bonds, and say that the value that a mutual fund gives to the average investor is that it has teams of analysts, teams of experts who are able to pick stocks, bonds, manage the portfolio, decode global events, understand what a fight between Russia and Ukraine means for oil, what the US presidential election, for example, will mean for Indian markets. Okay, these are not things retail investors can really decode in a hurry. So you have that expert. Now you just replace beads with products and you get a very simplistic understanding of what a mutual fund is, where investors are pooling their money, they are contributing in a particular scheme, which has a fund manager who goes out and manages that money. So that in a nutshell is a very simple way of making you understand a mutual fund.
Absolutely. I think you've simplified it quite a lot for our viewers.
Yeah.
So thanks a lot for that. But let's come back to your book then. And in your book, you've mentioned a jam experiment.
Yes.
In New York.
Yes.
That experiment said that the bigger the choice of
Yes.
jams that was given to
Yes.
people, the less the sales of the jam, which is
Yes.
very contradictory to what
Correct.
one might have thought other way. But we're Indians and we love to be spoiled for choice.
Yeah.
So now that we have so many choices of mutual funds in the markets, and your
Yeah.
book also has a table that streamlines, like, you know, all of these choices, which one. But for the ease of our viewers, could you explain in a nutshell how would you go about picking the right fund for you?
So if you start from trying to pick a scheme from the universe of schemes, so there are over 1200 schemes, and when you start blending in options like growth or income distribution, direct, regular, when you start building these options in, you have thousands and thousands of options to choose from. It's very difficult for anybody to choose one out of thousands. So what you do is you reduce your choice set. You've got to actually find a way to cut the clutter and have a small set from which you choose.
Okay.
So the first thing actually is about yourself. You've got to place your future money needs in 3 buckets. Money that you need within 3 years, money you need between 3 to 7 years, and money you don't need for 7 or more years.
Right.
Once you've done that, then you start the process of shortlisting categories. So SEBI, has the market regulator, has said that open-ended funds, so we know they are open and closed-end funds, we are talking of open-ended funds, which means it's like a never-ending escalator, you never get off. You need not ever get off, these schemes never die unless they are wound up. Okay, so a closed-end fund will end at a certain point, and open-ended fund is a forever fund. So SEBI has classified open-ended funds into 37 categories. There are 11 in equity, 16 in debt, 6 in hybrid, and 4 more. You don't need 37 categories, you need maybe a maximum of 10 categories across equity, debt, hybrid.
Right.
So the first thing would be to understand that in the debt category, you will place your short and medium term needs. From that, you will shortlist the categories which best match your holding period and your risk needs. Okay, so let's say you pick 2 categories from debt, and then in equity, there is a much, you can do much more in terms of portfolio construction. So you pick maybe 4 categories. Let's say you pick large and mid, small cap, mid, and out of the hybrid, you pick aggressive hybrid. Let's say that. You've already cut the clutter from 37 categories to just 10.
Right.
From these 10, now you start the process of selecting schemes. So I'm saying first divide your needs, short, medium, long term. Then you match that with the categories which are out there. Once you've got those categories, now you start the process of scheme selection, which of course goes into a lot of detail in the book.
Right, absolutely. Let's move on then. And if you had to take a pick between active funds or passive funds, what's your pick?
Both.
Both.
It's like, yes, look, active funds, so what is a passive fund? It's basically mimicking an index, right? So these are great starter products for people who have never tasted either mutual funds and or equity, specifically equity.
Right.
So a broad market index fund on the Sensex and or Nifty 50 would allow an average investor to get the growth, the average growth of the market, right? So the average growth of the market has been since inception on the Sensex about 14.5% per year, which is not a bad return
Not
at all.
all.
Projected future is also see, your index growth is dependent on the GDP number plus inflation plus equity premium. When you mix all of that, 12 to 14% is what the predictions are. So the index passive makes the safer part of your equity portfolio. All right, so even within equity, there is higher risk, middle and low risk. So I would say use a broad market index to do the safer part of your equity. There is enough juice left in categories like mid and small cap for investors who've been with funds for at least 2 to 3 years to start choosing active funds from the mid and the small cap for that return kicker.
Right.
Okay, so I'm saying it is never either or. In my life, it's always both. The proportions will depend upon what suits you, what your risk capacity is, how much time you have. Some people are perfectly okay. I know people who have just bought an index on the Nifty, and all that they do their entire lives is just they're happy with that average return.
They hold it.
It's a forever fund. Every month, part of their salary goes into it, and I know they've done it for 15 years. All right, and when you look at what their return and some of the people who are trading their returns, look, the evidence is out there. A person like Warren Buffett says, for the retail investor, it's a no-brainer. Right, so I'm saying both.
Both.
Yes.
Both. That's a good answer. So a lot of people who watch this show are young working professionals who just started getting a fixed income. So is mutual funds sahi hai for them as well?
Investing sahi hai. The biggest risk for you at your age, and with you I mean your age cohort, is not investing. Okay, so you have to invest. That's sahi hai is investing. Now what you invest in depends on your ability to understand a product like mutual funds. So if you are a risk averse FD only investor, you are exposing yourself to the risk of inflation. Okay, so I think you also need to understand different phases of risk better. So if you want to keep your long-term money ahead of inflation and taxes, you have very little option than to go to equity. Right. What better route than a mutual fund, which again I have to go on saying that the capital market regulator SEBI has spent hours and hours of work over 15 years to get this product safe in terms of fraud, in terms of malpractice for retail investors. Okay, so under the bonnet, we have one of the best constructed products in the world. And I say that with confidence because I've been a part of the discussions which have worked on these rules.
Right.
Okay, so a financial product can have a lot of monkey business going on inside.
Absolutely.
So regulator has worked very hard to reduce that monkey business. There are no commissions in the front of the product. There is only a trail commission. If you don't want to do that, you can also go direct. So there are a whole lot of options for people, and it is worth the while of young people to understand this category, this route to investing, so that when you use it, you benefit from it. And the example that I like to use is this, that a sports car in the hands of a person who cannot drive is a disaster.
Is of no use. Absolutely.
It's going to kill him, her and people on the road. But an expert can make it fly almost. Mutual funds, if you don't know, you are going to lose money. You have no option. If you want to use mutual funds, you have to spend time. And in this book, you have to do equal amount of work. I have done the work to write the book. There are no easy routes when you work with me. I will make you work equally hard because I'm not spoon feeding. I'm not giving you 5 funds to invest. I'm not going to give you tips.
Right.
I will get you to work equally hard so that you own the process. So then if you own the process, you don't have to constantly come back. Then I can't sell workshops to say, if you want to know more, then you buy this. Okay. So I don't want to do that game. I'm saying the book aims to empower you to learn. Once you learn, you can do this on your own your entire life. So front load your effort so that you do the work now. You have your entire life for investing ahead of you. Right. It's not a one-time thing. You will do it. You will manage your money till the day you die.
Absolutely.
Okay. After that, it doesn't matter. But till the moment you are living, you need money and you will have to manage it. So that's my message to the millennials and Gen Z.
Very interesting takeaway coming from you on that note. Very interesting words. But let's talk about goal-based investing. Let's say if I have a very specific goal that I'm going to need X amount of money in 1 year. Would someone like me still prefer mutual funds over, let's say, more security that comes from a fixed deposit? Would mutual funds still aid someone if goals were very hard, like set in stone?
You then pick the category where the risk to the principal is very little, but so will your return. So in
Okay.
that case, what you do is you will pick a category, for example, a money market fund, okay, and you will look at what sort of returns in 1 year the liquid fund has given. But that's not a good predictor of what it would do in future, because interest rates move up and down. So if you want specifically a fixed amount, maybe a fixed deposit is better. If there is a little bit of an elbow room, a money market fund is a good choice for people who have a little bit of flexibility on the exact amount that they want. Because like everybody knows, there are no guarantees. These are risk-bearing products.
Right.
But should you then go to a corporate deposit because the interest is higher, you are taking a far higher risk than you would in a money market fund. So be careful with your risk taking. So people who want the money in a year go towards a bank deposit, see the interest rate and say, oh, the corporate deposit is giving so much more.
Right.
They completely forget that this is a very high risk product. Corporate deposit is not a bank deposit. So if you're going towards that, you may as well be with a safer product, which is a money market fund. And SEBI has an interesting thing called the riskometer. So I've again spent a lot of time talking about how to use that and how important it is in a debt fund.
Okay.
Right? I'll leave that for readers to read in the book.
Absolutely. Something great to look forward to in the book as well. And I remember when I was reading your book, something that really stuck with me was the movie theater example you had given on account of, when to know when to leave.
Yes.
So we've spoken in depth about mutual funds. Viewers, I hope, have understood what mutual funds are and how to enter them, how to deal with them. When do you know when's the right time to leave?
Okay, that's a really good question. Because I get asked very often, is it a good time to enter and is it a good time to exit?
Exit, yes.
And I'm saying only you can know the answer, because if you look at markets, somebody tweeted the other day, good time for your book to come because markets are going up. So I answered, markets have been going up since 1981.
Since always.
Okay.
Yes.
Because markets go up, if an economy grows, markets go up. So when to exit depends upon something called your asset allocation, which investors have no option but to understand this. What is this? My split of my investment between equity and debt. Debt is the safer part of my portfolio. It's meant for needs which are within 7 years, 5 to 7 years. Equity is really my long term.
Right.
So suppose, and you have to fix this ratio, 60% equity, 40% debt, taking into account everything that you have, all your fixed deposits, your PPF, your PF, all of that becomes a part of your debt portfolio. All the insurances, the rotten insurances you have, you add that into the debt box. Equity is any direct stocks, any mutual fund, equity funds. Debt funds also come in the debt category. So suppose your ratio is 60-40, okay, 60% equity, 40, depending on age, stage, goals, whatever. Markets go up, this 60 becomes 70 and this 40 becomes 30. That is your cue to sell equity, bring it down to 60 and add to debt. Okay, so that's your cue. Your allocation is your cue to book profits or not. It does not depend on the markets. It depends on your allocation. There is a tax impact. So what I suggest investors do is, instead of booking those profits and taking home the tax problem, your incremental investments you put into the category which has become lighter.
Okay.
Okay, because look, you get a salary every month, you have to invest every month. You have to get into that rhythm of every month investing. So the minute there is every month investing and you want to increase debt allocation, you're automatically not buying the asset class which is very, very expensive right now, isn't it? So you have to always find ways to reduce your tax impact. But for that, your foundation of understanding of what you're doing has to be very, very good.
Very solid.
Yeah.
Yes. Okay. I'm going to quote a line from your book that comes very early on in the book, but it leaves a very long lasting impact. And the line is, money is good, it is not evil. It is how we earn it and how we spend it that might have moral values. But itself, the desire to be affluent is good.
Yes.
Could you elaborate a little bit on this?
Absolutely. I mean, we all have a poverty mindset. Maybe not your generation so much, but my cohort grew up in a socialist India, where we were still in that mindset that you put poverty on a high pedestal, and the only way you can get rich is through smuggling gold or charas or doing something which is wrong. So therefore, we've looked at the rich with a very suspicious eye.
With a negative view.
Very negative view. And I'm saying that this generation is different. You people have been born after the economic reforms.
Right.
Why are you carrying our old rotten philosophy on your shoulders? You don't need to. It is over. That part of India is over. That story is over. So I'm saying money is good, isn't it? Everyone,
Absolutely.
why should we distribute poverty? Should we not aspire for wealth for everyone? So I'm saying as a goal, being rich is very good. Moral questions, if at all, and everyone's morality is their own.
Very
Nobody can
different,
tell
yes.
you.
Very subjective also.
Yeah, it's your own business. You want to spend on whatever, it's your business. Nobody, has any moral right to come and tell you, yeah, achha, this is not good. How you earn your money is important, and how you spend it finally will reflect onto your own life.
Right.
But these are decisions that you have to take. So I'm very against deciding for anybody whether they should drink that coffee or buy that bag or that shoe.
Up to them.
Nobody's business, okay? It's the person who's earned the money, it's their business.
Interesting.
There are consequences of everything.
Right.
That you have to decide. You have to be mature enough to see where that road leads. So that's that line, that money is very good, everybody should have it.
On that note, do you think, in your opinion, can money buy happiness? It's a long-lasting debate. It's a big question.
That's right. Of course it can buy happiness to a certain level. You need, so again, that same research also shows that you need money for your basics. There is a certain level till which it does buy you a certain lifestyle, a certain degree of comfort. Look, if I have a child to put through education in a course that he or she really wants to go, it does buy me happiness because I can afford it. I have some patient in a family member in hospital.
Right.
I need the money. It's going to buy me happiness to make that person feel better and come back. I like, some hobby that somebody might have, which might be expensive. Somebody wants to learn how to fly an aircraft. It's an expensive hobby, but it gets you great happiness to fly. It does buy you happiness. There are limits to that happiness. After a while, the marginal utility of money falls.
Absolutely,
So every
yes.
incremental unit of money will buy you less and less. But till a certain point, I don't think we can lower the role of money in our lives. It's a very leftist, socialist ideology which they make everybody feel guilty about. This desire to be rich, this desire to be wealthy, so they make you guilty that this is a very low goal. I'm saying no, it's a very good goal.
It's not low at all.
Of course not. Everyone should be rich.
Okay. Great takeaway coming from that. Let's quickly jump into a very interesting rapid fire. So complete this sentence.
Okay.
I like mutual funds because?
They give you a lot of options. It gives you a lot of choices. It is customized for a retail investor. A lot of the monkey has been brought out of the product.
Okay. In your book, I couldn't help but notice when you mentioned cryptocurrency, currency is written in apostrophe.
Right.
So what is your view on crypto
It's
in
not
general?
a currency, it's colored marbles that people are exchanging. It's nothing. I mean, it's a stock has an underlying company which makes goods and services. A bond has an underlying lender and borrower. It's a financial transaction which is securitized. A cryptocurrency is a digital token with no underlying value.
No underlying.
So it has got value in closed loops of enthusiasts. So it's like saying this person has a golden marble, this person has a silver, and the two people are exchanging for some value. So to that extent, the currency is an inverted, it is not a currency.
Not a currency.
Will never be unless it is a government cryptocurrency.
Backed by something.
So government is backed by itself.
Right. No, I meant the currency, maybe if it had an underlying security, like how currencies are tethered to gold.
Currencies are not tethered to gold. That gold standard went off long back.
Went away, yeah.
No, yeah, so currencies are now no longer tethered to gold. So no, unless like for instance RBI is experimenting with the digital currency, but a privately held code will never replace fiat currency.
Absolutely.
It will not. Okay, because remember, for again crypto enthusiasts, you are giving up, you don't trust your government, but you will trust the code written by one private person and use that. I'm saying it doesn't make sense. It just does not make sense.
Absolutely.
Okay.
I'm glad we share views on cryptocurrency. Very
That's very
similar
rare.
views. That's very rare.
I have been trolled about my views, but
No, like you said, people's money is their business. Your views are your own business.
And I do not hesitate in talking about it. I spoke about it in that entire 2021 run-up of crypto. I went on saying, don't do it, don't do it, don't do it.
It was an inflated balloon just popped.
It
One
was
fine day
linked
just
to
popped.
you have to look at the Fed's easy money policy in the US, which was keeping rates to zero for years beyond it was required. Every time there is liquidity in the system, you get asset bubbles. So sometimes it's property, sometimes it's stock market. This time, luckily, it was crypto. So we didn't have a art or a property or a stock market bubble. We had this gigantic crypto bubble, which has burst. So that's what it was. So the minute the Fed rate hike and the crypto fall are mirror images of each other. You have to see the chart.
Interesting.
Yeah.
Do you have any favorite category of mutual funds, or do you prefer something over the other?
Right. So in debt, again, in the book, I have shortlisted some, and I would encourage people to understand why I have shortlisted. Like even in equity, there isn't like one favorite, but people are afraid of mid and small caps because of the volatility and the risk. It is there. But if you have staying power and if you have a very long-term understanding, long-term is 7 years or more. It is not 3 years. It is 7 years or more. If you have the ability to pick, again, given the system in the book, these are very good return kickers. So I'm fond of these categories which are very high risk. A new mutual fund investor should not begin investing using these high risk categories.
Okay.
But I like them personally because of the return potential that I see. And I'm investing in equity also for return.
Right.
Okay.
Okay. Let's talk about an average, let's say 28 or a 30-year-old's portfolio. So what is the ideal allocation that mutual funds should have in this person's portfolio?
Again, mutual funds is, so it's, see, portfolio will have equity, debt, gold, real estate. Again and again I will say mutual fund is not, it's not an asset class. An asset class is equity which has certain attributes. It is debt which has fixed deposits, bonds, PF, which has gold, which has physical gold, gold ETFs, sovereign gold bonds, real estate in terms of any investments which hopefully now will be through REITs rather than physical properties. So the question that I can answer is that what is the allocation between equity and debt? That's your basic level of. So again, depends person to person, but a rough rule of thumb is 100 minus your age is your equity allocation.
Interesting. Okay.
For what it's worth. So thumb rules are just sort of mental markers to say that, oh, I only have 20% in equity, and the rule of thumb says I should have 70. So maybe I need to relook at my own portfolio and why am I hesitating to put more into equity. So remember, 80-year-old will still have 20% in equity.
Okay.
Okay.
Got it. So rank in order of your preference when you pick a mutual fund. I'm going to throw a bunch of factors at you.
Okay.
You've got the fund manager, the fund manager style, past performance of the fund, the fund house itself, the reputation of the house, the AUM it handles, and the expense ratio. So rank in order of how important each factor is to you when you pick a mutual fund.
So performance comes on top, and performance mixed with consistency of performance. I want the scheme to be in the top quartile over 10 to 15 years, if not 20. Top quartile means out of 100, this fund is always in the top 25. Okay, I don't want the top performing fund. I want my scheme to remain in the top 2 quartiles. So sometimes what happens is a fund manager misfires and it drops into the second quartile. As long as most of the time it's in the first quartile, sometimes it's slipping into quartile 2, I'm okay with it. So consistency of performance is very important. Ideally, I would like large AUMs because it's only a fund which has been in operation for like 15 years which will have a large AUM. So it's an indicator also of age of the. I would also put risk metrics at number 3. Your list didn't have it, but I would put risk. Before expense ratio, I would also want to look at something I have explained called risk adjusted return. I would want to look at that because I don't want that return to come because the fund manager has taken undue risk. Then I will look at expense ratio. Fund house is also very important, so I would look at fund house as well because you can have a personal favorite or you may not like certain fund houses. Fund managers are not that important because a lot of fund houses are now putting in processes so that you don't have these star fund managers anymore. I'm not such a big, style doesn't really matter to me because finally what matters is at what risk, at what expense have you brought the returns that you have done for the last 10, 15, 20 years.
Okay, let's talk about a very recent buzzword that's on everybody's mind right now, and that's artificial intelligence.
Right.
What role do you think artificial intelligence could play at a fund house in terms of, picking the best securities or the best equities for you? Would you trust artificial intelligence more than you would trust a fund manager?
At the present moment, no. I think it has much more work to do, but the way that it is able to process data better than a human brain, I might think that a fund manager might use it to process a lot of data, but a lot of times it's also the fund manager's instinct.
Right.
So I would love to have a match of the two.
A mix of both.
Yeah, where I cannot do away with the human fund manager because it might, a commonsensical notice of something which the machine is not picking up might still be what makes us as human beings still important.
Yes.
Otherwise, we are redundant.
I do not think AI will ever get an instinct per se,
No matter how. No, we don't know at the moment.
We don't know yet.
We don't
Interesting
know.
to see where that one
Yes,
goes.
we don't know. So at a different level, it forces us to think what makes us human. So that's a different conversation.
For another time.
Yes, for sure.
Okay, to wrap it up then, your book quotes the song Hum Hai Naye, Andaz Kyun Ho Purana. It's from Dil Chahta Hai.
Yeah.
Is mutual funds the new Andaz? And is it here to stay for long?
Correct, absolutely. In the 60s and 70s, you had a socialist system of economy where the government controlled everything from interest rates to pricing of IPOs, to the insurance company, to the mutual fund. So you had limited products, you had limited choices. After 91, you have a market which is booming, blooming, growing. Choices are so many. So it's a completely new market. So if there is a new market and a new generation, a post-reform generation, why do you want to repeat our mistakes?
Right.
Okay, that's all. Don't repeat our mistakes.
Interesting. Great to have you with us in our studios today. Wonderful chatting with you. And I hope our viewers have some great takeaways to take from this interview.
Thank you so much.
Thanks a lot for your time.
Thanks.
Thank you.